Hi, everyone. Now it's time for us to talk about the fourth financial statement, the one remaining financial statement that we're required to prepare in a set of financial statements that will be blessed by auditors. Let's talk about the statement of cash flows. Now, prior to 1988, U.S. GAAP required a statement of changes in financial position, which was also called a funds flow statement. Now, funds flow statements were pretty severely criticized in the financial literature for adding really very little value or insight to the financial health and the operations of the business, though. There were a number of problems. Used the same accounting method as did the other financial statements, the accrual method. So it tended to be nothing more than pulling accounts from other financial statements and lining them up. It provided, in this context, really very little new information. The focus of this funds flow statement was the net increase or decrease in working capital. And that proved to be the real heart of the difficulty in trying to find value in the funds flow statement. Working capital is the excess of current assets over current liabilities. Working capital, therefore, involves only current asset and current liability accounts. And what we did when we prepared this financial statement was that we literally calculated, these were all the sources of working capital, these were all of the cases in which we consumed working capital, and the bottom line of the financial statement was the balance. Now, unfortunately, current assets and current liabilities increasing, for example, current assets, doesn't necessarily mean that the business is doing particularly well. And indeed, we discovered that focusing on net working capital, we had the opportunity to actually mislead financial statement readers about the relative success of the business. For example, if we have a ballooning, substantial increase in accounts receivable or a substantial increase in inventories, then both of those could lead to a substantial increase in net working capital. Now, unfortunately, the message we were sending to the financial statement reader could be that this business is doing exceptionally well. Its working capital is going up substantially, when in point of fact, what we may be looking at is increases in receivables and inventories because we can't collect our receivables and we can't sell our inventories. So we didn't always send the right message, and there was a real risk that we could send the wrong message, focusing as we did on increases or decreases in working capital. The result was a lot of discontent with this financial statement. And when we thought about what it didn't provide any kind of grouping of common activities, which means it simply listed all of the sources and all of the uses of working capital, all muddled together. That was a major failing of this financial statement. And when we see how the cash flow statement works, it'll become more apparent, I think. And then we discovered that this financial statement was really a very poor predictor of bankruptcy. It gave us no hint at all, in most respects, that the business was running into serious problems. So we decided that we would go in 1988 to a statement of cash flows. Now, the focus of the statement of cash flows is cash. We no longer use the accrual method of accounting. We're going to report on the statement of cash flows only those activities that generate or consume cash. So if we sell something and we receive only a receivable for that sale, it doesn't really have a place in the body of the statement of cash flows. Real focus on cash. And we're going to group the activities of the firm. We're going to report cash increases or cash decreases with respect to operating activities, investing activities, and separately financing activities. The result is that we're going to give some really important new information to the financial statement user. If you think about those three kinds of activities, ultimately, every business that's going to survive must have positive cash flow from operating activities because it's the only source of cash, the gasoline that makes this engine run. It's the only source that's continuing. There's a limit to how much we can generate by selling our investments and selling our property, plant, and equipment. And certainly there's a limit to how much money we can borrow or how much we can induce other people to invest if we are not successful generating cash flow from operations. So this number turns out to be enormously important because this is how a business survives in the long run. Right, the statement of cash flows format in concept looks like this. We're going to calculate cash flows, inflows or outflows from operations. And we're going to show cash flows from investment activities separately as a separate number. And then we're going to show cash flows from financing activities as a separate number. Now, the addition of the three numbers that we're going to be generating here should give us the net change in cash for the year. And if I add the beginning balance of cash for the year, I should be able to generate the ending balance of cash for the year. So from a functional standpoint, what this financial statement does is it breaks cash flows down into their three primary sources, and then it calculates a change for this year. And then what we manage to do is bridge two cash accounts, the beginning cash account and the ending cash account. And this number should be your ending balance, this number is the ending balance of cash for last year, and this number is the ending balance for cash this year. So what we should be able to do is to go back to our balance sheets and see that our statement of cash flows produces an ending balance of cash here that's equal to that ending balance on the balance sheet for the year. Now, we do such a good job of describing changes to major accounts in the body of this financial statement that it was decided that we should also provide as supplemental information exchanges that didn't involve cash. So we're going to provide in supplemental information an indication of the nature of transactions where we may have exchanged common stock for land or a note for new equipment. There's no cash involved in those transactions, and so there's no basis for reporting them up in the body of the statement of cash flows. We're going to solve that problem by indicating these material non-cash transactions here in supplemental information, rather like a footnote, but on the face of the statement of cash flows. All right, so the cash flow statement advantages are very significant. We're going to be focusing on cash and the reasons that cash balances change from year to year. This is really significant new information. Looking at the traditional accrual method financial statements, you don't really have a basis for generating these data, these insights. We're also going to show that cash flows, and we're going to group them by source. And this is critical new information. Remember, operating cash flows are the essential quality, positive operating cash flows, the essential quality of a business that's going to last for very long. And we're also going to see some important relationships in other accounting data that will be quickly shown. And we're going to find that the statement of cash flows is, as you probably anticipated, a much better predictor of insolvency. In truth, you can sometimes get a 3 or a 4-year advanced warning that a business is entering a period of bad performance and poor cash flows by looking at the statement of cash flows. Without it, you may need several more years of data to be able to determine whether that's really true. All right, In preparing the statement of cash flows and in thinking about it conceptually, we're going to say that our operating activities, the things that are reported in the first section, are our revenue-producing activities. We're going to very specifically define investing activities. We're going to say that investing activities are cash flows from the purchase or the sale of property, plant, equipment, or investments. So cash flows that are associated with those kinds of assets belong being reported here in investing activities, not in operating activities. And finally, we're going to define financing activities as cash flows from external financing sources, either debt or equity. It could be stock or it could be contributions from owners if the business isn't a corporation. Okay, so those definitions are key in defining the kinds of activities and the kinds of cash flows that we'll report in each of the three sections of the statement of cash flows. Then we've got two choices of format that can be employed in reporting operations. The first has been characterized as the direct method. And the direct method, in terms of its format, uses an income statement kind of format. It's pretty easy for the unsophisticated financial statement reader to read and understand. We're going to start with cash flow from customers. That'll be your primary operating cash inflow. And then we're going to subtract from that 3 or 4 or 5 different varieties of cash outflows, expenses typically, cash flow to suppliers, that sort of thing. And the result will give us net cash flow from operations. The second method that we're going to use is the indirect method. And the indirect method adjusts accrual net income to show cash flow from operations. So the first line is going to be a number that you've already generated on your income statement, net income. And then we're going to follow that with 3 specific kinds of adjustments. And that will yield cash flow from operations. Now, regardless of which format you use, you get the same answer. So we're talking here only about formats of communicating the information to the financial statement user. The direct method looks like an income statement, and because it's pretty straightforward, people who know income statements are pretty comfortable with this kind of format. It's much more readily understood by unsophisticated financial statement users. Easier to read, I think easier to grasp the big picture. But we lose some key information. We're going to combine a lot of accounts and a lot of data in each of those lines that we involve ourselves with. And perhaps most importantly, not all companies gather the information necessary to prepare the statement of cash flows in this format. So when we're doing the operating section, we've got 2 choices, one of which, the direct method, isn't really usable for a lot of firms because you have to gather very specific kinds of data that are not gathered. This is what the statement of cash flows looks like if you use the direct method. Now, we don't need to look at investing activities, we don't need to look at financing activities in this instance, because we're just talking about this section here, okay? And using the direct method, you start out with cash flow from customers, and then you subtract cash payments for purchases of merchandise, in this case, selling administrative expenses, interest, income taxes, and we calculate the total of those numbers, and we subtract that from cash from customers to yield net cash provided by ops. So that's one of those 3 most important numbers we're going to generate in this financial statement. Now, if I use the indirect method, I'm going to see that I give a lot of details of operating cash flows. I get much more information for a sophisticated financial statement user. And I'm going to discover that all of the companies are going to have the data needed to prepare this financial statement. The format is complex and cumbersome I mean, it looks like one randomly selected some accounts and threw them on. It doesn't have an intuitive sense to it. And it's probably, as a consequence, a good deal more difficult for unsophisticated financial statement users to understand. But because all companies have the data necessary to prepare this financial statement, it turns out to be the most commonly used format. It's not the preferred format, but it is the most commonly used format. Now, the last copy of Accounting Trends and Techniques I saw, which analyzes this sort of thing, we found that about 97% of companies report using the indirect method. Now, this is 97% of publicly traded companies. The result is that the direct method is really used relatively little. And for our purposes, we're going to focus on the indirect method. So as far as I'm concerned, we are going to study, and your textbook primarily presents the indirect method rather than the direct method. So this is what the indirect method of the statement of cash flows looks like. Again, focusing primarily on cash flows from operating activities. You start by including net income as the first line. Now, this should be the net income number that comes right off your income statement. So from the student's perspective, you've already got this one right. Then we're going to make a series of adjustments. These adjustments are designed to turn this $50,000 number into cash flow, remembering that that net income number was generated using the accrual method of accounting. And you'll note that the answer is the same. It's still $62,000 of net cash inflow from operating activities. Okay, so what we want to do after this is focus on how we prepare this financial statement, and we'll do that in the next of our series. Thanks a bunch, and I look forward to hearing from you.